All right, so you've placed a credit spread trade. Maybe it's moving in your favor. Maybe it's slowly turning against you, and now you're sitting there asking yourself the one question every options trader eventually faces. When do I get out? Today, we are breaking down exactly how to manage credit spreads from start to finish, including when to lock in your profits, how to handle a trade that's going sideways, and a few critical mistakes that can actually cost you more than your supposed maximum loss. Stick around because that last part alone could save you a serious amount of money. Let's set the stage real quick. A credit spread is a defined risk strategy. You sell an option, you buy a cheaper one further out of the money to cap your downside, and you collect a net premium up front. The appeal here is obvious. You know your worst-case scenario before you ever enter the trade. That peace of mind is genuinely valuable, especially if you're still building your trading confidence. But just because your risk is defined doesn't mean you should be passive about how you manage these positions. Knowing when and how to act is what separates disciplined traders from people who just cross their fingers and hope. When the trade is working in your favor, you put on a credit spread and the market is cooperating. The trade is moving in your direction, and your position is gaining value. A lot of newer traders feel the urge to hold on and squeeze out every last dollar of profit. Resist that urge. The smarter play is to set a clear profit target and stick to it. A widely used benchmark that serious traders rely on is closing the position once you've captured around 50% of the maximum potential gain. Why 50% and not more? Because the math works out in your favor. The remaining potential gain often isn't worth the time, the risk, or the capital that could be deployed elsewhere. Once you've hit that target, take it off the table, celebrate the win, and go find your next opportunity. Holding out for the remaining 50% introduces more risk than the reward justifies, and time in the market always carries exposure. A simple way to make all of this easier is deciding how you will manage the trade before you even enter it. Many traders skip this step. They enter the position first and then try to figure things out while the trade is moving, and that is where emotions take over. A better approach is to define your plan up front. Know where you will take profits. Know when you will close the trade if it is not working, and know how you will handle it as it gets closer to expiration. When those decisions are already made, you are not reacting in the moment. You are simply following a plan you already trusted. Let's flip the script. What happens when the trade isn't going your way? Emotional discipline becomes everything here. The first thing to pay attention to is time. When a credit spread approaches 21 days until expiration, it becomes a critical decision moment. This is not only true for losing trades. Even if the position is up a little, sitting at break-even or down, that time frame is often when experienced traders choose to either close the trade or roll it forward instead of continuing to hold and take on more expiration risk. If rolling makes sense and can be done without paying a debit, it is often worth considering. Rolling means you close your current spread and reopen a similar position in the next monthly cycle, buying yourself more time for the market to potentially shift in your direction. The key phrase is rolling for a credit. You never want to roll a position if doing so requires you to pay out of pocket, because that adds net risk to a trade that is already struggling. It is just as important to understand what not to do when managing these trades. One of the most common mistakes is holding and hoping. The trade moves against you, and instead of making a decision, you wait, hoping the market turns around. Sometimes it does, but over time that habit creates bigger losses than necessary. Another mistake is constantly adjusting without a clear reason. Rolling too often, moving strikes randomly, or adding more contracts can turn a simple trade into something much more complicated and risky. Good trade management is not about doing more. It is about doing the right thing at the right time and then stepping back. Most of the time, the best decisions are simple, even if they are not always easy. If the trade has moved so far against you that rolling for a credit is no longer possible, you face a harder truth. Sometimes you just have to sit with the loss and let it expire. That stings, no question about it. This is exactly why position sizing matters so much when you first enter a trade. A common guideline many traders follow is to risk no more than around 2% of their account on a single trade. If your position size is appropriate for your account, an occasional max loss is something you can absorb and recover from, without it putting you at risk of blowing up your account. Every trader who plays this game long enough will experience a position that goes fully against them. The ones who survive are the ones who planned for it ahead of time. There are situations where you can actually lose more than your defined maximum risk on a credit spread. Even a supposedly capped risk trade can behave differently under the right conditions. The first scenario involves pin risk. Imagine your credit spread is approaching expiration and the stock price lands directly between your two strike prices. Your short option is in the money, but your long option is out of the money. You could get assigned on that short option over the weekend, ending up long or short the actual stock, while your protective long option expires worthless. By Monday morning, you are exposed to the full movement of that stock with no hedge in place, and if the stock moves sharply before you can close it, your losses can exceed what you originally defined as your maximum risk. Another situation, while less common, still happens, and this is known as after-hours assignment risk. A stock closes just barely out of the money on Friday, and it looks like the trade is safe. After the close, the company releases earnings or major news, and the option holder on the other side can still choose to exercise if they expect the option to be in the money by Monday's open. You wake up unexpectedly assigned with real stock exposure. Early assignment is another possibility. It does not happen constantly, but it does occur, and if you are assigned early on your short option leg and do not act quickly, you can end up exposed in the same way. The fix is simple. Close both legs immediately without overthinking it. Avoiding these situations comes down to one core habit: closing or rolling your credit spread somewhere between 2 and 3 weeks before expiration. This removes most of the assignment risk, pin risk, and early assignment scenarios. Waiting until the very end is rarely the optimal move, and once you decide to close or roll the trade, how you execute it also matters. Execution plays a bigger role than most traders realize. Market conditions can vary throughout the day. The first hour after the market opens, roughly between 9:30 and 10:30 in the morning, is often the most volatile, with fast price movement, wider spreads, and less consistent fills. Later in the day, especially in the final hour before the close, around 3 to 4 in the afternoon, activity picks up again as positions are closed and volume increases, which can also create unstable price movement. Closing or rolling during more stable periods, typically late morning or early afternoon, can help you get better fills because liquidity is steadier and pricing is more consistent. It is a small detail, but over time, execution matters, and the price you get when you close or roll can have a real impact on your overall results. Another factor to consider when managing trades that are in that middle zone, not a clear winner and not a clear loser, is implied volatility. If volatility is still elevated compared to historical levels, there may be a reason to stay in the trade, since higher volatility is what allowed you to collect more premium in the first place, and a drop in volatility after entry tends to benefit credit spread holders. If volatility has already collapsed, the edge that made the trade attractive may no longer exist, and in that case, whether you are sitting on a small gain, a small loss, or just breaking even, closing the position and moving on may be the smarter decision. At the end of the day, managing credit spreads comes down to process. Enter with defined size, ideally risking no more than around 2% of your account on a single trade. Set your profit target ahead of time, typically around 50%. Manage the spread at around 21 days to expiration. Know your rolling criteria. Stay aware of the risks as you get closer to expiration, and do not let emotion override your plan. Traders who succeed with this strategy are not the ones who are right more often, They are the ones who stay consistent, patient, and prepared for different scenarios before they happen. If this helped you manage credit spreads in a way that actually makes sense, hit the like button and subscribe to Option Framework so you don't miss the next video. I'll see you in the next one.